Thanks for tuning into Talking Point. I'm your host, Niraj Shah. Between Friday market close and as this point of time, I I was witness to two very amazing events, if you will. One was, of course, what happened all through the day on Sunday, which is Credit Suisse, UBS, the Fed liquidity backstop, if you will, or actually a coordinated backstop, and the events thereof. And two, I attended an event by ValueQuest PMS, which they call as an inflection. And it was truly amazing to see the kind of conversations that happened around themes in India, which might have a multi-year multiple times growth opportunity if people choose to invest right. So I think what we'll do with our guest today, Ravi Dharamshi of ValueQuest, is try and tackle both of those things together. Ravi, good having you. Thanks for joining me.
Thanks, Niraj. Good to be here.
Yep. Ravi, so I think the things that we are trying to find out in today's Talking Point viewers is that whether the Swiss crisis have a material lingering effect on risk assets. Why does ValueQuest think that India is at an inflection point? Who can benefit from India's energy transition and how are they betting on such players? Are there nuanced ways to play the manufacturing renaissance in India? Something that was a key talking point in that event on Saturday. And is there a real possibility of a J curve in consumption? Much spoken about for a number of years, haven't quite witnessed it coming to fruition. Can this time around be different? So, Ravi, let me start off with the key talking point from a markets perspective, which is the whole last 1 month talking point on banks. Now, SVB, Credit Suisse, the Fed narrative changing, Swiss National Bank coming in. Are there lingering impacts to all of these, or will these be ring fenced in a manner of speaking?
Neeraj, absolutely. I think there is a crisis unfolding in the global markets, and the flows will not be immune to it. So that, to some extent, will impact us. However, having said that, I think you have to see where the genesis of this crisis lies, and I think a lot of it is in the fact that during COVID times, the developed world did not do a good job of both health crisis and the financial crisis management. They overstimulated the economy, and that led to a crazy increase in inflation. For them, for 30, 40 years, they have never seen 6, 7, 8 double-digit kind of inflation, and that's what they are witnessing. And I think that led to, of course, the kind of response from Fed in terms of increasing rates, and that is now, see, if Fed is going to increase the rates the way it has, 4 percentage points, 4% points over barely 6, 8 months, then surely that is going to break something, and we are starting to witness those things breaking. So SVB was just probably a flash in the pan, but eventually it is now moving to other shores as well, and this still remains a liquidity crisis. It can become a solvency crisis for some of the Western world economies and the banks over there, banking system over there. The only difference, I would say, as compared to the global financial crisis, is that this time around the playbook is kind of known, and of course the central banks will use the same kind of playbooks, and the response times are much quicker. As we have seen the last weekend, we saw the SVB depositors being bailed out, and this week we saw the Credit Suisse and the UBS merger being pushed through, and of course the coordinated action from the central banks in terms of providing liquidity to the world. All these actions are making the point that we have a problem, but the response to that problem is also quick. Now, coming to India, I think India did a brilliant job of managing COVID, both at humanitarian and health crisis level, as well as at the fiscal crisis level. Now, some might say that it was because we didn't have the resources. Surely that did not prevent previous governments from overstimulating or printing money, or when they did not have enough. So their credit is deserved that we actually did not balloon our deficit way too much. Our inflation is not running as hot as the developed economy. Our currency is far more stable. Our banking system is in a much better shape. So all that is making India actually an oasis in the world. Having said that, the global flows are going to be impacted, and if a fund is getting impacted, back in US, they are going to get out of assets which are providing them returns and liquidity. these are not decisions that are being driven by the fundamentals, but they are being driven more by where I am hurting and from where I can get the liquidity that I need, or where is it that I can lock in my gains so that at the end of the quarter or whatever, at the end of the year, I can show returns. So those are the kind of things that are driving the actions and not the fundamentals. I think India is an oasis in the world in that sense.
So are you fearful currently? Are you cautious or are you greedy?
So the time, obviously, to be careful was probably 15, 16 months back. We have had 15, 16 months of no wealth creation. Yes, we have been going up and down, up and down. It's been a consolidation correction. And now we are reaching a stage that this correction consolidation is culminating into a full-blown panic, probably. The local domestic investors have not panicked till date. But one, I can't rule out one panic over there setting in. Some amount of that is showing in the way the SIP flows are probably beginning to recede, or the rate at which it was growing is receding. And FIIs will probably end up, uh, they have already sold out of probably net $40 billion, and I think their value in the holding of overall is now down to less than 17%, as I understand, and that is historic low. So from FII perspective, their holdings are at historic low in terms of percentage of the equity of the market, and the short positioning in the futures is also very, very high. So they are clearly positioned to sell or create liquidity. That will reach an extreme point, and we will see a bounce back. How the domestic investors react to that, I think on the way up, probably they will also start, feeling the pinch. But till now, it is still pretty much a global crisis which is impacting the markets to a limited impact. There is no such economic impact over here as of now, or the impact on the financial system. So I am not worried beyond a 5-10% correction from here.
Hmm. Well, Ravi Dharamshi also has the view that, and a contrary opinion, that the rupee might touch 75 before it touches 85. We'll talk to him about that as well. But let me first bring in, like I said, a very impressive event that I attended, which was the inflection day that they put out. The inflection was the name of the event. Now, Ravi, why is it that you believe that we are at an inflection point? I mean, or India is at an inflection point? It's been a steady state growth economy, if you will. It's marched on to over 3 trillion as we speak. Uh, what do you mean when you say inflection, and why do you have this belief?
So yeah, so let me first explain the term inflection point. Usually, any there are curves, cost curves, capability curves, learning curves, which confluence, and at that point of time, suddenly a new paradigm is born. So, and just to give you an example from technology, in 2007, iPhone and Android was introduced, both within months of each other. Why? Because at that point of time, the technologies that enabled the smartphones became cost competitive, as well as there was enough in terms of availability. So for example, we had LCD display, or for that matter data, then sensors, or everything that goes into making a mobile phone, that all those things became viable at that point of time, and that gave birth to smartphone, and then smartphone gave birth to many, many industries, and that got adopted, and then there was an S curve adoption of that technology. That is what an inflection point is. So India has been growing at in the past in a very slow manner. There are so many issues. We had our moment of realization and moved from being overly socialist to capitalist. In the 91, we liberalized the economy. That was one inflection point that increased the rate. From that point of time, we have actually now started gathering more space. It took 67 years to reach $1 trillion, 8 years to reach the next trillion, and less than 5 for the third trillion. Now, going forward, each trillion is going to be added in a manner of 2 years, 1 year. So we are going to go to 5 trillion and 10 trillion over the next 8-10 year period. Of course, we could be off by a year or so here and there, but that is what the S curve is. This is how it is going to be. Now it is going to be a much, much faster rate of growth for India because of so many steps being taken. Now I'm from road infra to port infra to entire digital stack that we are talking about, the kind of regulatory infrastructure that we have put in place. So we have been constantly chipping away and adding to our infrastructure, to the robustness of the economy, and we have been cleaning up the system for the last 7, 8, 10 years. So this is what is now coming to a confluence and this is what is going to provide that path of a faster growth rate. That's what we strongly believe. And again, I'm not talking from 1 quarter, 1 year point of view. I'm talking about next 10 years. In the short run, of course, markets are going to respond to the crisis that is happening around in the world. But India will emerge stronger from this. There is no doubt about that.
Okay. So with that as a given, Ravi, let's try and figure out how then you as a large portfolio manager are trying to gain from this, right? So let's first talk about one of the themes that you had at the event, which was the J curve effect on consumption, right? Now, much spoken about for a really long time. We haven't seen the per capita really gallop up. A lot of people say that from this 2250 to 22500, whatever the number you choose, then it starts really moving, and discretionary consumption tends to benefit disproportionately. I would love to understand how you are thinking about this and how are you playing this.
So absolutely. See, the nature of the consumption, nature of the J curve is, if you see the first part of the curve is very slow. It takes time to build, and skeptics tend to disregard it, and people don't get used to it. But if you see at various parts in the country, city like Bombay or Bangalore is already about 10,000, 11,000, 12,000 per capita. So India might be at $2,000 per capita, but the some of the cities have already started picking up and going up. So, and you can witness the kind of consumption that happens in these cities versus what the entire pan India averages. So once the same kind of things happen in the, and it is already happening, the way we are witnessing, some of the speakers that we had, they threw a lot of light on, it is not about the metros or tier 1 or tier 2 as well. It is happening in tier 3 and tier 4. The Bharat that we have all been waiting for, they are witnessing. People are buying jewelry costing 25,000, 30,000 rupees online from a small town in somewhere in Northeast or somewhere in the heartland of India. And these are the signs that tells you that, okay, the consumption is picking up. Yes, there was some amount of pent up because of the COVID, and that is probably dissipating at this point of time. But the longer term trend is not in question at all. As the income levels grow, uh, people will have more and more discretionary income at their, and all that is going to be spent on healthcare, education, entertainment, living a better life, having more things with them. So to say, where they spend that money is what we need to constantly be, evaluating to understand which are the business trends to bet on.
Okay. So Ravi, let me ask you, in the whole day when you looked at or when you heard about the J curve comments from various guests, right? There was Bhaskar Bhatt, ex-Titan, and some financial names and some of the others. What was the standout comment according to you, which made you think that, hey, this is something that really stood out for me when I think of the J curve effect that might come into India in consumption?
So one of the companies that was part of the consumption theme is a company called Wow Momo, and the kind of growth that company has witnessed, okay, and how they converted COVID from a crisis to an opportunity was really awe-inspiring. Uh, 570 outlets, okay, that is no small feat. In fact, and the kind of ambition that company has tells you a lot about. They are not looking at dominating India. They are looking to take this category and a lot of things from India to become the MNC chains. Today in India in QSR, all the chains are basically MNC companies. This is the first one which is homegrown and has the kind of scale that can be in the top 5 in the terms of QSR chain. So I would say that the audacity of the Indian entrepreneur in terms of dreaming big is really coming to the fore. And we are actually not thinking only India, but we are starting to think global as well. So the one thing that he mentioned is that he is looking to make it a global brand and not only an Indian brand. And he's already mastered the art of retail rollout, standardization, sustainability. These are the two things which will ensure that they become larger in scale. Scalability, standardization, scalability, and sustainability are the are his mantra in terms of how retail has to roll out, and I think he's pretty much sticking to it. So that really opened our eyes.
Great. Wow. Very interesting to hear that. And it's good to know that, because I'm sure for every wow Momo, there are 10 others who are looking to become of that scale, and hopefully many of them will try and go ahead and do it. So suffice to say, Ravi, you betting on QSRs per se as a pocket, I mean, as a theme that could succeed because it fits in the bucket, right? Urban discretionary, higher spends, and maybe better operational metrics as size comes in.
No, absolutely. I think we are betting on it. We are betting on it in the listed space as well as in the unlisted space. And see, these companies are all reaching a scale of anywhere between 300 outlets to 500, 600 outlets. And this is the time at which they are throwing enough cash for them to sustain their own growth. So they are able to throw cash enough to add 50, 100 outlets on their own. Of course, if they want a faster growth, then they have to raise funds. But that is that inflection point in that business model that they can sustain that 25% growth through their own cash flows, whether it is store rollout expansion or whether it is same store sales growth. Both the things are, of course, so about 6 to 8% is what we expect the same store sales growth to be, and about 15% is what we would presume would come from store rollout, and about 3 to 5% is what the increase in pricing and valuation value would contribute to the growth. So this is a sector that is poised to grow for a 25-30% CAGR over a long period of time. Just to provide you with a perspective, Domino's in US has 7,000 or maybe 8,000 outlets, if I'm not wrong. And in India, we are there at 1,600 outlets. In terms of geographic expansion, we are not that small a country. We are a large country. And in terms of density of population, we are far more denser. So you probably need per square kilometer more number of outlets to service similar kind of a population. And the culture of eating out and calling or for a delivery or something has just begun in the last 2-3 years. So there is a long runway available for these companies, at least 10, if not 20 years. So I think they will sustain a long. And you finally want to see the secret of compounding is how large can you bet, at what rate can you grow, and how far long can you grow. So if you find a combination of a sector and industry where you can have a long runway and a growth rate which are high enough to sustain for a long period of time, you have to bet on it. Forget the short-term technical thing or okay, the pent up going out and some slowdown in the SSG for now. That is what is going to provide you with an opportunity to get in.
Great. Thanks for that, Ravi. So that's one. The other theme that you spoke about was the manufacturing renaissance in India. I would love to understand what are the nuanced way to play this theme, because it's a very wide market. So how are you focusing on this? And again, what was that one thing that stood out when the conversations happened at the event?
So first, let me make the macro case for the manufacturing renaissance. Why I believe so, because we have had many false starts, and this is one area where actually we have been lacking a lot. Okay, for the kind of country we are, for the kind of 75 years of independence, and manufacturing as the contribution to the GDP has always remained subscale, less than 10%. Even today, there are less than 10 companies probably that are doing more than 1,000 crores profit in the manufacturing sector. That is just not, we have not built scale at all. We have not been able to compete with the China and the Taiwan and the Korea of the world. So we need to get our act together in manufacturing, and it's one of the most difficult thing to do. The current dispensation has tried its best and they are implementing one after the another. But there is a learning curve to this as well. When 2014, the Make in India initiative was introduced, of course, there was a lot more sector, there was no focus, and the bureaucratic setup was not ready to implement the kind of policies that they had brought. So that along the learning curve, we started, reducing the number of the sectors, and we started using all kinds of tactics. It's not only like sam dam dan wave, use carrot stick, everything. So providing a tax incentive to providing protection from Chinese dumping, from even to the extent of banning exports, banning imports in the defense sector, and then providing PLI, which is I think a game changer, because you're actually incentivizing scale and productivity instead of earlier on we had inverted tax structure, and we were incentivizing remaining subscale and we were incentivizing imports. So all that has now been taken care, and finally, and of course, the infrastructure and the connectivity and the digital that assets that we've been building is all coming to the fruition now. So we are now going to witness, and now there is also a intent and motive on the part of the global customers. They want to diversify away from China. So China itself wants to cut down on the pollution. They want to become a consumption economy. India wants to move away from agriculture towards manufacturing, and the world wants an alternative to China. So all the things are combining and confluencing. And we have put enough force behind it for me to say that yes, we are at that inflection point, give or take a couple of years, but we have embarked on this journey, and already the green shoots are visible. The mobile manufacturing, even though low end, we have become net exporters from being importers, and electronic imports is the number two item in terms of contributing to the current account deficit that we have. So we have to correct that. And so again, that yes, the mobile manufacturing has begun at an assembly level. We still import components, but of course we cannot put the cart before the horse. You have to start somewhere. Yes, the low end work will come, then so the chip will come, the components will come, and then we will start manufacturing the whole piece. It is a journey, and we have embarked on that journey, and we are witnessing good success on that front. So we will pick up. I have no doubt about it. In fact, Apple just announced that they'll probably, the Foxconn will put a unit here, and the AirPods will be manufactured over here. So now this is the larger theme. Okay, it is imperative for India to pick up the manufacturing. World wants an alternative, and India can provide that alternative. And there is an added advantage that we have a good local big market that might or might not come in handy. But that's the scenario now. Within what we are betting on right now currently, so we have actually had one wave of chemical manufacturing that has happened. Okay, since 2014, when the Chinese pollution issues started, we witnessed that a lot of this, that was the first where the customers started talking about, because China started having arbitrary rules and they started shutting down factories. So people were looking for an alternative, and India was the one that was going to provide that alternative. So that move has happened, and it is happening. It is going to happen for a long period of time. Okay, we have just gone from 3% market share to 4%. I believe we should be 7-8% market share over the next 10. So chemical manufacturing will move, but the stocks have already factored in quite a bit of that optimism. They used to quote at single-digit P multiple, are now at 30-40 multiple. Even commodity companies started quoting 15-20 multiple. So from that point of view, we are tactically not aligned to chemicals. The two sectors that we have moved ourselves to within manufacturing is defense and sorry, I'm forgetting, electronics manufacturing. So defense and electronics are two space, and third is again railway is one more opportunity which I believe, but there are very few plays available. So but these are the two industries, the nuanced industry within manufacturing, in which we are bullish on. And again, we will manufacture for India, we will manufacture for exports, we will manufacture for providing to those who are building in India, and we will contract manufacture for others also. So there is a entire $1 trillion opportunity that is opening up for Indian manufacturers. Indian manufacturers are very small in comparison with the kind of opportunity that they are facing them. We have maximum number of our companies would be anywhere between 50 crore profit to 200 crore profit. A lot of these companies will go on to become billion to $2 billion kind of turnover and profits in excess of 1,000 crores, 2,000 crores. So that is where the wealth creation is going to happen over the next 10 years, and that remains a happy hunting ground in terms of manufacturing.
Very impressive, man. And the interesting piece is a point that you mentioned about the export opportunity for India. Much as the sector of defense is derided for being a B2G, but you're seeing increased instances of global companies place orders with Indian companies, and the non-India part being so high too. So thanks for that insight, Ravi. The last piece that I want to talk about is the energy transition. Now there, the Russia-Ukraine conflict kind of doesn't put a spanner in the wheels, but doesn't I mean, gives credence to the argument that while the energy sources are in the state of transition, it is not that the erstwhile energy sources have to be done away with or completely put out because there is merit there. I mean, it took Ruchi Sharma to bring to notice to everybody that, hey, oil may be really important for the whole of the decade when he said oil is the new data for the new decade. So my question is, are you completely betting on new energy? Is new energy overvalued as we speak? Because the world may need to move to fossil fuels as well because there's not enough new energy out there. And how to play this thing?
No, so first thing that we all need to understand as humans is that the world is facing a crisis. It is not a fancy thing anymore. Okay, we are talking about increase of 1.5%. Sorry, 1.5 degrees in temperature over the last 2-3 decades, and we are probably going to witness 5 degrees if we continue along the same path. And these kind of changes in weather happen over thousands of years. They don't happen in a matter of decade. And all this was triggered by industrialization that started 300 years back. So number one thing for us to accept is that yes, there is a crisis that the humanity is facing, this world is facing. So now once that is we are on the same page, then it is not about this technology is better or that technology is better or this is needed or that is needed. It's an all hands on deck approach. We are, as humans, are not going to give up on consumption because the world is facing at personal level, but we need to, we as much as possible, we need to be clean and green and sustainable in our approach. Every person needs to do that, every company needs to do that, every country needs to do that, every technology needs to be put to use. It's an all hands on deck approach that we need for to combat this crisis that is facing us. In that sense, yes, coal is not, India is still an energy growing country. Okay, the world over, probably the energy consumption is stagnant or on decline because their population has grown enough. So India is still growing in that sense. So we will need, and the base load is provided by thermal power. Today we don't have that enough amount of solar or wind energy to take care of the base load, and the technology is also not evolved as much. But that is what the learning curve is, right? Along the way you will realize that uh, now I'll just tell you that solar is the cheapest form of energy ever available to humans, and it is super abundant through the world. Okay, there are more number of countries that have that energy available to you. It's only about harnessing it. Now we have the technology available to harness it. So why would you not? Why would you put your control in terms of uh, oligarchs and some
Yeah.
few countries that extract that economic rent out of you, because the coal deposits and the crude deposits are in few countries, few geographies. This is the way for energy independence, energy security for 90% of the humanity. Right now, those resources are being controlled by few people, few countries. Less than 10% of the population controls the entire 100% of the world in terms of their ability to have that energy. So we have to move away from it. Okay, it's not a question. So, and the technology learning curve has evolved enough for it to be not necessarily only being driven by regulation. It is being driven by economics and costs and technology improvement and availability. Everything is coming to a confluence, and that is why it is an undeniable mega trend. Now, coming to whether we should still focus on coal, I think it's the last hurrah that coal or crude is going to have. And markets are very, very smart about these things. You don't get terminal value, you don't get valuations. Surely, I mean, China and India are still incrementally still going to invest in these assets, but you have to put it in perspective. Look at how much investment is going into solar and renewable. The kind of growth that we are witnessing here is usually associated with technology. The companies and the adoption is like they are doubling every year. Every country is joining in, every continent is joining in, and the growth rates are just stupendous. So if you can see that, and every technology eventually undergoes an X curve, the new goes the S curve and the old goes the Z curve. The coal and crude have already embarked on the Z curve. At what point it overtakes and when they are on a decline, it will happen very suddenly. We will not realize. 10-20 years down the line, we will not be talking about crude and coal anymore. We will let it remain within the under the surface of the planet. So I am clearly betting on where the opportunity is expanding, where the terminal value is also going to increase, rather than betting on a sunset industry.
Okay. Okay. Fair call. So that's where you bet on. And I'm presuming, just Ravi, before we end, how are you doing that? Because there are nuanced ways again to do this. So very quick summation of how are you betting on the new energy theme, and what is the standout in the event day as well?
That is the challenge. There are not too many plays available, especially on the listed market side. You are aware of the one or two that we do have, but that's why we we recently got our private equity fund approval, and we are looking to bet on some companies on that side as well. So one of the companies that we have bet on is witnessing huge scale up in the last. They've gone from being 2,700. It's a solar module manufacturing company that is backward integrating into cell and wafer, and they will also get into adjacent spaces like batteries and hydrogen and those kind of things. So this company has gone from being a 2,700 crore turnover to this year. This will be 6,500 crore kind of a turnover, and next year is likely to be 15,000 crore turnover. This is the kind of scale up that I'm telling you, and they have the order book in hand. It's not like they have to go and fight for this business. They have the advances also in hand, and the order book is growing by the day. On the profit side as well, the growth is like that. 70 crore profit last year, this year 400 crore. They'll probably end up making 700-800 crore profit or even more from that point of view next year. This is the kind of scale up and witness we are witnessing now. You have seen in most commodities that, yeah, we can have that kind of a profit scale up, but then it again comes back, and then it's a cycle of capex which brings it down again. Over here, we are still a little while away from becoming over invested, and that will lead to some kind of a down cycle. I think it is at least 5 years away, if not more. So we don't have to worry about those things at this point of time. Right now, there is more demand than these people can handle.
Great. Ravi, always a pleasure talking to you on nuanced themes and otherwise. Thanks for that added piece on SVB, Credit Suisse, and the impact thereof. All the best for the year ahead. We are almost at the end of the financial year. Have a great FY24. Looking forward to having more often on the platform.
Thank you so much, Niraj. It was my pleasure.
Yep. And viewers, thanks for tuning in to this edition of The Talking Point.